Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Capri Holdings Limited quarterly report. Capri Holdings Limited offers a diverse range of products and services through its three segments: Versace, Jimmy Choo, and Michael Kors. The company's product offerings include ready-to-wear clothing, eyewear, watches, jewelry, fragrances, home furnishings, handbags, small leather goods, scarves and belts, and shoes. The company operates a distribution network that includes boutiques, department stores, specialty stores, and e-commerce sites. This allows customers to purchase its products through various channels, making it easily accessible to a wide range of consumers. In addition to its own retail operations, Capri Holdings Limited also undertakes licensing agreements with third-party manufacturers for the production and sale of watches, jewelry, eyewear, and fragrances. The company's product portfolio is extensive, catering to both men's and women's fashion needs. Its brands are recognized globally, and it has a significant presence in various regions, including North America, Europe, Asia, Africa, and Oceania. With its diverse range of products and services, Capri Holdings Limited is well-positioned to meet the evolving demands of the fashion industry. The company's product offerings can be summarized into several key categories: apparel, ready-to-wear clothing, accessories, handbags, small leather goods, scarves and belts, shoes, eyewear, sunglasses and glasses, watches, timepieces, jewelry, fine jewelry, fragrances, perfumes and colognes, home furnishings. Decorative items for the home. The company's services include retail operations through boutiques, department stores, specialty stores, and e-commerce sites, licensing agreements with third-party manufacturers for watches, jewelry, eyewear, and fragrances. The decline in Capri Holdings Limited's stock price over the past year can be attributed to several key events that have contributed to ongoing negative trends and investor caution. One major factor was the company's missed earnings and weak outlook in February 2025, which led to a significant drop in its shares. This was followed by a credit rating downgrade from S&P Global, citing the company's underperformance across all brands and expectation of continued negative sales trends due to global demand slowdown and operational missteps. The fourth quarter results for fiscal 2025 further solidified this trend, with a substantial drop in total revenue and an adjusted net loss. These results were attributed to softening global demand for luxury goods, which has been a persistent challenge for the company throughout the year. Additionally, earnings volatility and legal risks have also contributed to the decline in Capri Holdings' stock price. The company faced a class action lawsuit and broader macroeconomic headwinds, such as inflation, which posed significant risks to its growth projections and investor sentiment. While some positive developments, such as beating Q3 2026 earnings expectations and reducing debt through the sale of Versace, have been reported, they have not fully offset the accumulated negative sentiment. As a result, Capri Holdings' stock price has declined by approximately 16.44% over the past year, reflecting ongoing investor caution regarding the luxury retail sector and the company's growth trajectory. Capri Holdings Limited market capitalization of $2 billion is materially smaller than most of its industry peers of roughly $4 billion. Capri Holdings Limited trades at a higher price-to-book ratio of 22.79 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 93% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has aggressively reduced its share count by more than 5%, indicating a strong shareholder-focused capital allocation approach. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. Interest expenses are consuming a significant portion of operating income, indicating some financial strain. However, special charges appear non-recurring, suggesting that earnings pressure may be temporary rather than structural. The primary drivers of revenue growth or decline can be identified through various factors. On the positive side, seasonality plays a significant role in revenue growth, with holiday season sales contributing to increased revenue in the third fiscal quarter. Additionally, cost savings measures such as decreased costs of goods sold and selling, general and administrative expenses also contribute to revenue growth. Furthermore, specific product lines and regions can drive revenue growth. For instance, Jimmy Choo experienced a 5% increase in revenue due to higher sales in the Americas. Retail sales growth, wholesale revenue growth, licensing revenue growth, gift card redemption rates, and loyalty program participation and redemption rates are also key drivers of revenue growth. On the other hand, several factors contribute to revenue decline. Macroeconomic conditions, inflationary pressures, costs of manufacturing, tariffs, and import regulations can negatively impact revenue. Foreign currency fluctuations, disruptions in shipping and distribution, and supply chain constraints also hinder revenue growth. The decline in number of full-price retail stores for both Michael Kors and Jimmy Choo is another significant factor contributing to revenue decline. Strategic initiatives not performing as expected and a decrease in promotional activity for Michael Kors, along with a continued slowdown in demand for certain categories of fashion luxury goods, particularly in Asia for Jimmy Choo, also contribute to revenue decline. Net income and profit margins. A shift from loss to profit, the company's net income has undergone a significant transformation, shifting from a loss of $546 million in Q3 2024 to a profit of $116 million in Q3 2025. This change is even more pronounced when looking at the year-to-date (YTD) numbers, with a shift from a loss of $535 million in YTD 2024 to a profit of $141 million in YTD 2025. The total change in net income is a substantial plus $676 million. The improvement in net income can be attributed to several factors. Firstly, the company's operating performance has improved, contributing to the increase in profitability. Additionally, there was a reduction in impairment of assets, which also had a positive impact on the bottom line. Furthermore, an increase in foreign currency gain also played a role in the shift from loss to profit. In terms of profit margins, while the gross profit margin saw a slight decline from 63% in Q3 2024 to 60.7% in Q3 2025, the operating income margin experienced a more significant increase from 2.4% in Q3 2024 to 4.5% in Q3 2025. This indicates that the company's ability to generate profits from its operations has improved significantly. Overall, the shift from loss to profit is a testament to the company's efforts to improve its operating performance and manage its assets more effectively. The increase in foreign currency gain also provided a welcome boost to profitability. As the company continues to navigate the market, it will be interesting to see if these trends continue and whether they can sustain their newfound profitability. The company's financial performance indicates a positive trend in its operating cash flow. According to the provided information, the net cash provided by operating activities is substantial, with a total of $1,219 million as of December 27, 2025. This significant amount suggests that the company is generating sufficient cash from its core operations to meet its financial obligations and invest in growth initiatives. A closer look at the data reveals that the company's operating cash flow has been consistently positive over the past year. The net cash provided by operating activities of continuing operations was $258 million in 2025, indicating a stable and reliable source of funding for the business. Furthermore, another report on page 58 confirms this trend, stating that the net cash provided by operating activities was also $258 million in 2025. Overall, these figures demonstrate that the company is generating positive operating cash flow, which is essential for its long-term sustainability and growth prospects. This financial performance provides a solid foundation for the company to invest in new opportunities, pay off debts, and reward shareholders, ultimately contributing to its overall success. The company's debt level has undergone significant changes over time. Specifically, long-term debt decreased substantially from $1,466 million to $224 million, while short-term debt also saw a decline from $24 million to $10 million. As a result, total liabilities decreased from $4,841 million to $3,225 million. This reduction in debt level is likely to have a positive impact on the company's financial health. In terms of interest expenses, there has been a notable decrease from $64 million to $45 million. This reduction in interest expenses suggests that the company may be benefiting from lower borrowing costs or more efficient debt management practices. Overall, these changes indicate a shift towards a more manageable and sustainable debt profile for the company. The performance of various segments and regions in the market has been analyzed. On a positive note, Michael Kors sales have been strong in the Americas, with $593 million in revenue over 3 months and $1,463 million over 9 months. Similarly, Jimmy Choo's performance has been impressive in both the Americas and EMEA, Europe, Middle East, and Africa regions. In contrast, Michael Kors sales have struggled in Asia, indicating a region that needs improvement. Jimmy Choo also faced challenges in Asia, with its performance being considered poor. These results suggest that while some regions are thriving, others require attention to boost sales and revenue. Management's outlook on the company's future is optimistic, with sufficient liquidity expected for the next 12 months and beyond. A significant investment of $100 million in fiscal 2026 has been planned to enhance store renovations, IT systems, e-commerce capabilities, and marketing initiatives. The company's strategy also involves mitigating cash flow risks through forward contracts, net investment hedges, and interest rate swaps to manage exposure to foreign currency exchange rate fluctuations. This proactive approach aims to ensure stability in the face of external market uncertainties. In addition to these measures, a 3-year share repurchase program worth up to $1 billion is scheduled for fiscal 2027, contingent upon favorable market conditions and other factors. The company has made significant moves in its business strategy through acquisitions and divestitures. In terms of acquisitions, one notable example is the merger between Capri and Tapestry. This strategic move aimed to strengthen the company's position in the market. On the other hand, the company has also engaged in divestitures, which involve selling off certain assets or businesses. A notable instance of this is the sale of Versace. By divesting itself of Versace, the company may be looking to focus on its core operations and streamline its business. Concerns about inventory buildup and supply chain disruptions are evident in the recent data. Inventory levels have been increasing, with a notable jump of $1 million from December 27, 2025 to March 29, 2025. This growth in inventory may indicate potential issues with managing stock levels. Furthermore, there are significant disruptions in shipping and distribution networks, leading to supply chain constraints. These challenges include port congestion, vessel unavailability, container shortages, and temporary factory closures. Such disruptions can have a ripple effect throughout the entire supply chain, impacting businesses and their ability to meet customer demands. That concludes the financial summary for Capri Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.